The rich do not get richer simply because they work harder. That is the public story. The deeper story is that wealth grows differently from income. Income is earned, wealth is owned. Income depends on time, effort, and labor. Wealth depends on assets, leverage, and appreciation. And once an economy becomes more dependent on rising asset values, the people who already own those assets begin moving ahead faster than everyone else. That is why the gap keeps widening. Not because money magically multiplies at the top, because the system rewards ownership more than effort. Most people think wealth comes from saving. You earn money, spend less than you make, and slowly build security over time. That logic works at a personal level. But at a system level, large wealth usually grows in a different way. It compounds through ownership. Stocks rise, property appreciates, businesses expand, equity gains value, debt amplifies returns. This means wealthy people are not just saving more, they are positioned differently inside the system. They own the parts of the economy that rise first. And when those parts rise faster than wages, wealth pulls away from labor. Wages grow slowly. They rise through promotions, job changes, negotiation, or productivity. That process takes time. Asset prices do not move that way. They respond to liquidity, interest rates, investor demand, scarcity, and expectations. When rates fall, assets often rise quickly. When credit expands, assets often rise further. So while workers negotiate a salary increase over years, asset owners can gain the equivalent of many years of wage through appreciation alone. That is one of the biggest hidden differences in the modern economy. Labor grows in steps. Assets reprice in waves. Compounding sounds simple, but its real power is rarely felt at the beginning. It becomes visible later. A person with modest savings earns modest returns. A person with large existing wealth earns large absolute gains, even when the percentage return is the same. 10% on 10,000 is small. 10% on 10 million changes a life very little, because that life is already changed. So once a person has enough capital, growth becomes increasingly detached from daily effort. The asset base starts doing the work, and because the gains are added back into the asset base, the next round grows from a bigger foundation. That is why wealth acceleration often feels unfair from the outside. The system becomes easier to navigate once you already have scale. When inflation rises, workers usually feel it first in expenses: food, rent, insurance, transport, utilities. Wages rarely adjust immediately, but asset owners often get a different experience. Property values rise. Rental income can rise. Stocks may reprice based on nominal growth. Scarce assets become more attractive as currency weakens. This means inflation can hurt wage earners while protecting owners. So even when inflation appears broad, its effects are not evenly distributed. The cost of living rises for everyone, but the ability to pass that cost on belongs mostly to those who own assets. That is another reason wealth keeps concentrating. Owners adapt faster than earners. The rich do not only invest more money, they can also borrow against what they already own. That matters enormously. If a person owns property, equity, or a business, banks are often willing to lend against those assets. That borrowed money can then be used to buy more assets, fund new investments, or protect liquidity. This is leverage. And leverage makes asset ownership more powerful than wages. A worker is paid after labor. An asset owner can often expand before realizing gains. So wealth is not just about what you hold. It is about what your holdings allow you to control. That is why access becomes a multiplier. Wealth creates options. Those options create more wealth. Many people assume the rich keep getting richer because they pay less tax. That is partly true. But the more important point is how different kinds of gains are treated. Labor income is taxed as income. Asset growth often sits unrealized until sold. And if an asset is held for long periods, tax timing becomes more flexible. This difference matters. A worker receives money, then pays tax. An asset owner can watch value rise for years without needing to realize it immediately. That means capital can continue compounding with it the same constant friction. The issue is not only tax rate, it is tax timing. Timing affects compounding, and compounding affects inequality. Wealth also changes the quality of opportunities available. Small savers usually access public markets, basic savings products, or residential housing if they can afford it. Large asset holders gain access to private funds, better financing terms, institutional deals, commercial property, early-stage investments, and structured financial products. In other words, wealth buys access to better forms of wealth generation. The return is not only on capital, it is on proximity, proximity to deals, proximity to information, proximity to networks. That is why large wealth can grow through channels that ordinary income earners never even see. Housing is one of the clearest examples. For people who already own property, rising home prices create equity. That equity can support refinancing, borrowing, upgrading, or purchasing additional property. For people who do not own, rising housing costs create the opposite effect. Bigger deposits, higher rents, less saving capacity, more delay. So the same market creates wealth on one side and distance on the other. That is why housing inequality widens so quickly. Ownership compounds. Renting absorbs. The divide becomes larger even if both groups are working. That is what makes the issue structural, not moral. Modern economies are deeply financialized. Pensions, index funds, private equity, venture capital, real estate funds, and corporate buybacks will reinforce the value of owned capital. That means the economy is designed to reward scale. If you already own financial assets, you participate in the upward movement. If you do not, you mostly experience the secondary effects: higher prices, higher rents, higher valuations, and higher barriers to entry. So wealth concentration is not an accident at the edges. It is often a byproduct of how the center now works. An economy built on rising asset prices will always reward existing ownership. This is where the public conversation often goes wrong. People want the explanation to be personal: hard work, talent, discipline, better decisions. Those things matter, but they do not explain the whole pattern. Because if the gap were only about effort, wages would track wealth more closely. They do not. The bigger reality is that once returns to ownership exceed returns to labor, inequality widens even when everyone is trying. This is not about denying achievement. It is about understanding the environment achievement operates inside. The game is different when one person is climbing with income and another is compounding through assets. Once wealth reaches a certain size, preservation becomes easier, growth becomes easier, and risk becomes more manageable. Losses can be absorbed, time horizons can be longer, patience becomes affordable. That is powerful, because many of the best opportunities in markets belong to those who can wait. A person living from paycheck to paycheck cannot always wait. A wealthy person often can, so even volatility can become an advantage for those with reserves. This is one of the least discussed aspects of inequality. Time itself behaves differently when you have capital. The rich keep getting richer because modern economies increasingly reward what people own, not just what they do. Assets appreciate faster than wages. Leverage magnifies ownership. Tax timing favors compounding. Access improves with scale. Inflation protects owners before earners. All of these forces reinforce one another, and once they overlap, wealth stops behaving like a savings result. It behaves like a system advantage. That does not mean upward mobility is impossible. It means it becomes harder when ownership outruns labor for too long. Wealth is not only about money, it is about position. Position inside markets, position inside credit systems, position inside the structures that reprice first. That is why the rich keep getting richer. Not because they are playing a completely different economy, because they are standing in the part of the economy that rises first, compounds fastest, and gets protected earliest. And until labor catches up with ownership, or ownership stops dominating the system, the gap will keep widening.